Good morning, I'm Gary DeWaal, and this is Bridging the Week for August 13th to 17th, and today is August 20th, 2018. The Securities and Exchange Commission halted an initial coin offering of a new digital token that was not associated with any application on any blockchain. Separately, the SEC also fined a combined investment advisor and broker-dealer for not having written policy and procedures designed to detect misappropriation of customer assets by rogue representatives. And unfortunately, misappropriation occurred. I am in Chicago for the early part of this week and will try to enjoy some of the great architecture while here. So I might get outside as soon as possible to do so. Let's get started. David Lawrence consented to a permanent prohibition from acting as an officer or director of a publicly traded or reporting company, as well as from being associated with any offering of a penny stock company, as a result of his involvement in the offering of digital tokens known as Tomahawk coins, or TOM, from July through September 2017. Mr. Lawrence purportedly engaged in such offering in conjunction with Tomahawk Exploration, a company of which he was the sole managing director. According to the SEC, during the relevant time, the respondent sought to raise $5 million through an initial coin offering of TOM to support an oil and gas exploration project. Potential purchasers of TOM were told they could trade their digital tokens on a token trading platform for potential profits and would have an option to convert their TOM into Tomahawk equity at a later time. TOM were marked as quote-unquote low risk with high potential rates of returns, said the SEC. Moreover, noted the SEC, Tomahawk claimed, among other things, that its, quote, risk-adjusted returns are exceptional, end of quote. The SEC charged that these and other promotional statements were materially false and misleading. Apparently, the respondents did not raise any funds through their ICO. However, said the SEC, Tomahawk issued 80,000 TOM to persons in exchange for online marketing and promotional services as part of a so-called bounty program. Recipients of TOMs were able to convert their digital tokens to other crypto assets on a decentralized platform. The SEC claimed that the bounty program constituted the offer and sale of securities that were required to be registered or issued pursuant to a bona fide exemption, but were not. In addition to his agreement to an officer, director, and penny stock bar, Mr. Lawrence agreed to pay a fine of $30,000, and both respondents consented to a cease and desist order. Seems like an old type of fraud, but just new technology. As I was quoted last week in the New York Post, quote, "This is just another wolf in a different type of sheep's clothing, but still, it's sheep's clothing," end of quote. Ameriprise Financial Services, Inc., a registered investment advisor and broker-dealer, agreed to pay a fine of $4.5 million to resolve allegations made by the Securities and Exchange Commission that, from 2011 through 2014, it failed to have and follow adequate written policy and procedures designed to prevent the misappropriation of client assets by persons associated with the firm. The SEC said that, during the relevant time, 5 firm representatives engaged in various fraudulent acts, including forging customer documents, to steal over $1 million of customer funds. Although Ameriprise considered fraud by its employees to be a risk for which it implemented an express compliance and supervisory framework that relied on various manual automated tools, aspect of 2 of its automated tools to detect fraud and misappropriation broke down and contributed to the relevant fraud not being caught, said the SEC. In one circumstance, a program meant to detect when an account address was changed to an address of a person associated with Ameriprise failed to work properly and was not tested until December 2013. As a result, said the SEC, 2 representatives were able to change addresses for 2 of their clients to their home addresses, thus facilitating fraudulent check disbursements. In the other circumstance, a program intended to detect suspicious disbursements made by check where the address of a payee matched to a name or address of a person associated with Ameriprise was defective because the tool was too literal and solely flagged exact matches. As a result, for example, the payment to an address that included AVE when an address of the firm included avenue would not detect that precise address. The system also did not flag suspicious wire transfers. These limitations, claimed the SEC, enabled the misappropriation of customer funds by a third Ameriprise representative. Various manual and system breakdowns also contributed to the misappropriation by the other two representatives, alleged the SEC. In determining the amount of Ameriprise's fine, the SEC said it considered that the firm reimbursed all its customers for the misappropriated funds, fully cooperated with the Commission's investigation, retained a compliance consultant to assess the effectiveness of its policy and procedures to safeguard customer assets, and enhance its policy and procedures, including implementing a new automated money movement and control system. Well, that's it for this week's edition of Bridging the Week. As always, there's more information in each article, and more articles on the article version of Bridging the Week at www.bridgingtheweek.com. Check it out. I'm Gary DeWaal. Have a great week, and until the next edition of Bridging the Week, ciao.